All right, so there's a problem in America today. Everyone says buying a home is the smartest financial investment you can make, but what if it's actually a trap?
I bought a house when I was 26 and fell immediately into poverty.
Is buying a home actually the American dream, or is it just an illusion we've been sold to by banks and the financial system? For most of our lives.
All right, before we really get into this video, though, I want to stress that I know a lot of people aren't in a position to buy a home, but if you're thinking about it, or if this is something that you were like really pressed on doing, I want y'all to really watch this video and truly grasp what the guy's saying. And we're going to break down exactly, is it the smartest move if you got some money in your pocket right now to buy a house?
Success in America has been dictated by the house you own, the car you drive, and the place you work. But these are also the same things that can completely crush you financially and lead you into a hole that feels almost impossible to get out of. You see, all of the financial gurus on the internet would like you to think that renting is the dumbest thing you can do in your 20s. You're just throwing money away, you could be building equity instead, or the assumption that real estate values always go up. And they argue that buying a home is the smartest financial investment you can make. But when you look at the real numbers behind it all, is that actually true? Let's break it down. For this example, we're going to look at this $500,000 home.
And it sounds crazy. We're looking at a $500,000 home, but I believe the average cost for a house being bought today is like closer to like $400,000, which is crazy. It is crazy. That's a high price, but we're looking at $500,000 right now.
We'll compare buying it versus renting it and include all of the hidden costs you don't think of. If you were to purchase this home for $500,000 with 20% down, you'll be spending about $115,000 upfront for the down payment and closing costs. With that out of the way, you're now looking at a $2,489 mortgage payment every month. But it doesn't stop there. You'll also need to factor in property tax, homeowners insurance, and maintenance.
All right, so these are the numbers. Let's slow this down a little bit. He said 100,000 down. So he's talking about 20%. And I know you're going to hear the people out there say, oh, all you need is 5% down to 3% down, people, which all you're doing is those numbers that you see in terms of the mortgage payment, the extra cost, inflate those even more. So if you don't got the 100 grand, which most of y'all don't, and y'all say, oh, I can get it for 5% and come up with, I don't know, $25,000, $30,000 or whatever. Even if you can buy that house for $30,000, $40,000, you're going to up every other cost. So don't look at the 100,000 and be like, oh, I'm not listening.
Which would add an additional $1,229 per month. So all in, you're going to spend $3,718 per month to own this home. Now,
3,000. Let's look at that again. He said 3,000.
All in, you're going to spend
$3,718 a month if you go and buy a $500,000 house.
$15 per month to own this home. Now, if you want to rent that same home, you're looking at a monthly rent of $2,500 and maybe about $20 a month in renter's insurance. So all in, you're saving about $1,200 per month.
Rent versus own. Rent versus own. This is what the numbers is looking like. And the crazy part is he's looking at the monthly thing, but he also, you got to stress to people that renting, you don't got to put that much money up front. So if the rent is $2,500 a month, let's say, you're putting only $5,000 up front, sometimes more. Sometimes they want a little bit more than just the last month's rent. But you're looking at, let's say, $6,000 up front for renting a house. Now, if you want to buy this same house, and he said 20% at $115,000, you're still looking closer to $50,000 at, you know what I mean, a lower percent buying a house. So that's a dramatic difference when people say, oh, what's better about renting and all this other stuff. The upfront cost is by far better.
Just by renting. But this is where every financial guru wants to climb out of the woodwork and shout about equity. And I totally get it. But the problem is, to build equity in a home, you need to own it for an extended period of time, because that mortgage payment you're making every month is mostly just interest in the beginning. Under our current example, about 85% of the $2,489 is going toward interest, and only $364 is a.
Let's run that back.
$89 is going toward interest, and only $364
$2,000 is going toward interest, while $364 is going toward the actual principal. And in this live stream, I'm gonna be stressing interest the most because you can use this interest rule to mostly anything out there, because all y'all do is get loans. So this same interest principle can get factored into cars, which I'm gonna bring in to play, and then student loans. But interest is the biggest factor for why I personally do not like loans. I don't like getting loans.
is applied to your $400,000 mortgage. So you're spending an extra $1,200 a month to earn $400 a month in equity. Not exactly a one-for-one exchange like we're told online. That said, rent does increase every year, and home prices also typically increase every year. So
yo, shout out my man's Javier, man. He was the one who sent me the video. You know what I'm saying? So all love to Javier. If you out there watching, you feel me?
It's safe to assume that when you go to sell that home, you'll end up making more. But it all depends on how long you hold the house for. And with the average first-time home buyer only holding their home for 2 to 5 years, the investment in a home looks even worse. Going back to our example, we're going to play this out like we had lived in the home for 5 years, then decided to move. Every year, the home value went up by 3.5% and the rent increased by 3%. Both pretty standard rates today. After 5 years, the home is worth $593,800.
All right, he's talking about after 5 years, that's how much the home's going up. But shout out my man's Twan in the building. You feel me? Let me show these comments. He said 100K. Most of y'all don't got. Who don't? My fault, bro. My fault. I forgot. Listen, I got a friend group. They big hitters. So as my man Twan Bird, I guess he got 100 in the tuck for a house. I'm sorry. I don't want to disrespect none of my people out there that's really getting to it.
$45. But after 5 years, you've only actually paid down about $24,000 of your mortgage. So when you go to sell that house, assuming you can actually sell it for $593,000, you'll walk away with $182,264 after closing costs. But if you had been renting that whole time and placed the $100,000 you didn't spend on a down payment into the market, and you threw in the additional savings of $1,200 each month compared to a mortgage, assume
Eli, you got 400. You got 400. Can I get a loan?
Being a 5% annual return, you'd be looking at an investment portfolio worth around $207,000. To clarify, these are rough estimates, so real world numbers may differ, but we're just trying to get a general idea of the impacts here. So roughly speaking, after 5 years, you would walk away with about $25,000 more in cash if you had rented the home. But does that mean you should rent forever and that owning a home never makes sense? Not exactly, because renting comes with its own set of problems. And a more specific problem you might face on a daily basis is trying to find.
All right, we don't need the advertisements, buddy.
Thank you again to Torres for sponsoring today's video. Now let's look back at the problem with renting a home. When you're renting a home, you don't get a say in what happens. If you want to paint the walls, maybe you can, maybe you can't. And at the end of your lease, if your landlord decides not to allow you to renew, you might have to move out. And moving costs can add up quickly over those 5 years. So best case scenario, your landlord is great and everything goes to plan. Worst case scenario, you move a time or two throughout those 5 years and you can't make any changes to the house, which all could eat into that $25,000 difference pretty quickly if you're moving every couple of years. And like we already.
All right, well, how big are these houses that we moving in and out of? I had a moving business, and shoot, if the money was looking like this, to where thousands is getting taken out at a time for moving, sure, I still probably would be in business.
Covered when you're renting, you're not building any equity. So in theory, your rental payments are just kind of being thrown into the wind every month without any real return coming back to you. But if you really think about it, owning a home is kind of the same thing. In both circumstances, you are paying a monthly fee to live in a space.
Facts. That is key. Just because you quote unquote bought a house and you have a mortgage, that is not your house. Let me say that again. Just because you bought a house doesn't mean it's your house. It is the bank's house, especially if you don't come up with the money. If it was your house and you had the bread, it's your house. They don't care. but they're taking it every time. So for my people out there that love talking about, oh, own this, own that, it's not yours until it is fully paid off or you paid off that loan. So no, you're not a homeowner. You're not. We're going to watch a little bit more of this video, then we're going to get on to the next thing.
Fee goes depends on if you're renting or owning. But in both options, you are paying someone else to live somewhere. So it comes down to how much control and flexibility you want to have over your life. Because if you're looking at this from a purely financial point of view, it might not work out like you think or expect it to. You see, unlike what the real estate gurus would like you to believe, the housing market does not always go up. And even when it does, it might not end up the way you want it to. Everyone loves the stories of boomers who bought their homes in 1958 for $12,000.
Listen, I ain't hear one bad thing that he said about renting. I'm going to keep it a buck. Just because you want to change up your wall and stuff and they say no, that's not a big deal. And so, and this is my argument when it comes to buying a house and renting. I think it is a terrible investment to own a house and live in it if you don't have a lot of money. And I'm talking about a lot of money to where you can pay that house off in the next 10 years. So a situation like that, all right. Or if we're doing 15-year mortgages with 20% down, that is better. And that is better due to the fact of interest. At the end of the day, when it comes down to smart investments or not smart investments, it is about interest. Because like he said, in those first 12 years, you are going to be putting all your money that you think you're putting into the mortgage, into the home, on interest. Like if you wait out 30 years of time paying off a mortgage and you wait 30 years, I think it was like close to like 70% of the value of the house will be paid on interest alone. So after 30 years, let's say you bought a house for $200,000. After 30 years, you probably are going to pay in just interest close to like $150,000 on just interest. So that means that house you thought you paid $200,000 for, you paid $350,000 for it. And guess what? That's not it. You paid property taxes. Any damages that you caused yourself, you're paying for. We're talking about lawn care, landscaping. We're talking about you got to fix the roof every 15 years. If the city says that your sidewalks aren't up to par, you got to pay all that. And that's on top of the mortgage. That's on top. We're not even talking about electric. We're not talking about water. That's what I'm saying. We can really dive deep. And this is a problem that people don't truly look at and value. So how I look at it and how I'm going to get into real estate, because I don't say don't buy a house. I don't think it's the worst thing to not buy a house. But what I'm going to do is I'm going to buy a house as an investment property. And it's key because you want to buy it as an investment property because of tax purposes. Another reason you shouldn't live in the house and not buy, you should not buy a house and live in it is because you can't write most of it off. The only thing you can write off on that house if you live in it and you don't make it a business is the property, the property taxes and the interest, I believe. I think it's just the interest. You can write off the interest. So that means that at the end of the year, let's say you paid $10,000 in interest. You can write off that interest. But if I had it as an investment property and I move somebody in, I can write off anything I put my money into. So if I fix the wall, that's the whole thing's a write-off. If I fix the toilet, if I fix the kitchen up, anything I put my money into to fix up this property, I can deduct it on my taxes. So that's why it's automatically better to have somebody else living in it, is because of tax purposes. When you start moving smart and really try to level up and get your money right, taxes is the most important thing that you can do. Like true people that make true money know that you live your life through taxes, which I'll break that down later on in probably another video, but that's the biggest thing. And so once I get my renter in there paying rent, let's say he's paying $18,000 a year now. You know what I'm saying? Let's say his rent's close to like $1,500 a month. He's paying $18,000 a year toward the mortgage. What I'm going to do is I'm going to put my money on top of that $18,000 and get it paid off even quicker. So I'm going to be hitting the principal while the person that's in my house is going to be attacking the interest. So I'm going to try to get my house paid off in the next 2 to 3 years, which now I'm going to minimize how much interest I'm paying, because I'm only going to be paying, let's say, 2 to 3 years worth of interest, which isn't going to be a boatload of money. While on top of that, after those 2 or 3 years, which I put a lot of money into paying off this house, I'm going to be making $1,500 a month, let's say, off of this property. So $18,000 a year is going to be going into my pocket. I do got to pay property taxes. But also, people are forgetting, I also still have $150,000 equity. Let's say if I bought a house for that, you still got the equity in the property even after you pay it off. So you could take out a loan, but I ain't into that. I mean, on the property. But that's just a little bit of how I feel about real estate, what I think about it, and the numbers, and doesn't make sense. But I hope you guys took something out of that. I also want to talk about another specific thing when it comes to real estate. I ran across this video.